equipped and maybe they were already doing bathware, so they had a good know-how of the business. So from market to market, we have taken a decision whether we want to cross-sell through existing channel or whether we want to open up an exclusive channel. So to answer your question, 27 would be a combination of pipe distributors as well as new distributors for bathware.
Understood. And on the current sales of this existing brand, how much of it would be to projects or it's all distributor-led?
Majorly distribution and retail. There are a few large builders in Bombay who are using, but especially in projects, having the ability to serve an entire project on time becomes very, very important. So there are builders who were Aquel loyalists. So we have been meeting a few builders as well, and I think the project business is going to be one key where we will be able to revive that business as well. But to answer your question, currently it's majorly distribution driven.
Understood. Thanks a lot. And all the best, Sneha.
Thank you, Sneha.
Thank you. The next question is from the line of Nikhil Agrawal from VT Capital. Please go ahead.
Yeah. So wanted to understand the replacement cost. You mentioned it is 35 to 40 crores. So it does not include the land value as well. The remaining 6.5 acres that is left.
So when we say that 30 to 35 crores is 35 to 40 crores is the replacement cost, it includes the land also, not necessarily the same size. Typically this kind of facility comes in the range of 3 to 5 acres very comfortably. So we have excess land back at our disposal, which we will use for our future expansion.
Okay. And can we expect that the next leg of expansion, like we currently have Bihar on the pipeline. After Bihar is we begin production in Bihar. So can we expect that the next leg of expansion will take place in this plant only, or are we looking at some other facilities?
So let me I'll like to clarify. Bihar is for pipes, fittings, and water tanks. Which currently what we have purchased is only for faucets. Out of 8 acres, 2.5 acres is currently being used for faucets. Balance area is available for us to manufacture any of our products, whether it's bathware or our existing products. We already have 2 facilities in Silvas, one in Kolhapur and one in Jaipur. So currently in West we have enough capacity. So the balance land in Bhuj we would be using to expand the bathware, maybe water tanks, which is sensitive to logistics, but no plans as of now. Currently, I think the entire focus is to sweat out the existing asset at Bhuj by really focusing on the front end of the bathware segment.
Okay. And when can we expect the revenue to come in, like from this quarter itself?
From the second quarter of next financial year, I think it will become a relevant number for the bathware.
Okay. And what is the order book size, if you could help me with?
So see, while I say order book, that means it's this is not a B2B business. This is still a distribution-driven business. So when we interact with the company or with the distributors, we understand that if there was strong supply security, the appetite of the distributors is much higher than what the company is able to currently deliver because of their balance sheet constraints. But this is not a B2B business where we have large orders or some contracts or anything like that we win. But basically, there is a significant mismatch in the appetite of the channel for Aquel and what the company is currently able to serve because of cash flow constraints. Now, with a company like Prince coming up and our balance sheet, at play, we will be able to basically close that gap. So with this kind of a brand, this kind of a manufacturing facility, distribution network, and our execution intent, I think that's going to be a combination that really excites us.
Okay, great. And so any other inorganic opportunities are you looking at in this space currently?
I think in bathware this is enough for now. I think now the focus has to be to put our head down and execute. As far as pipes and water tanks are concerned, all of you would be aware there is a lot of stress at the bottom of the pyramid, and there is opportunities coming up virtually every few months. And we explore all those opportunities. But like I said in my opening remarks, we have used inorganic in the past. In 2012, when we acquired the Chennai and Kolhapur plants, which actually worked out very well for us to build our footprint in South India for pipes. So we are not averse to inorganic growth, but we will be extremely selective and prudent while taking these kind of opportunities. So we have the risk appetite for it, but it's not just because the opportunity is there, we don't want to do the deal. But there is ample opportunity in the core business of pipes and water tanks. And for Bathware, I think we are good for now. We have a solid brand and manufacturing footprint now. Now we just have to focus on execution.
Okay, great. So lastly, on your core pipe business, like you said that we're projecting a flattish year-on-year growth, but the demand situation out there is really, like, it's quite good, and the market is expecting, other players are expecting about 15% plus volume year-on-year growth. So what exactly is the issue with our company? Like, are we losing market share, or are we still not recovering from the market share loss because of the SAP implementation?
No, so we are, like I said in the previous quarter's Concall, the transition issues are behind us, the supply chain issues behind us. Some of the corrective pricing action also has been taken, and we will continue. So for the year, we will still be growing on a quarter four basis. Year on year for quarter four, it will be similar to last quarter four, because I think it will take a quarter for us to gain back the market share that we lost during the ERP transition, and we believe that the growth engine will be back from the June quarter. So the fundamentals remain the same, and we continue to be bullish on the core business, which is why we are adding up capacity as aggressively as we are, and preponing some of our capex plans as well. So fundamentals remain the same, and we'll be back to being not only growing in line with industry, but one of the fastest growing in the industry, which is what we are used to for so many years.
Okay, great. Got it, sir. All the best. Thank you.
Thank you.
Thank you. The next question is from the line of Udit Gajiwala from Yes Securities. Please go ahead.
Yeah. Hi, sir. Thank you for taking up my question. So just one point, like you mentioned that some of the dealers of Aquel, they had stopped taking orders because the parent was unable to fulfill the orders. So there would be a case that they might have switched to other brands by now, since you said that the best financials were 1 decade ago, and it has dropped drastically. So, there'll be challenges for you also to pull them back, and might have to incentivize you more.
Yeah, we might have to incentivize them more, which is we are okay to do that, because for us it's still a net positive and net entry into a new channel and a new market. It's not like a pipes business where we are well entrenched and have a high brand recall. So it's in Bathware, our first goal is to establish a channel. And apart from the active distributors, reigniting the inactive distributors also, I believe, is worth the effort, because it helps us become more deeply penetrated into a market which is unexplored for the Bathware segment. So it accelerates our go-to-market.
Understood, sir. And so the brand will be sold as Aquel by Prince, or it will be Aquel with the new logo that you have just telecasting?
So product will say Aquel. Packaging and collaterals will have Aquel by Prince. But on the product, it will just be Aquel.
Understood, sir. That's it. Thank you, and all the best.
Thank you.
Thank you. Participants who wishes to ask questions may please press star and 1 now. The next question is from the line of Chintan Modi from Haitong Securities. Please go ahead.
Hi. Thank you, and congratulations on the acquisition. So can you share that, how old this plant and machinery would be, and when was the last revamp done, and what was the cost for that?
We have taken inventory of the plant and machinery over there, and they are in a working condition. We have seen the maintenance schedule of assets as well. 2 years back, they had done periodic check. sometimes in 2022. And when we'll take over this plant, then we'll have to take some corrective action in terms of operating machines, and we'll have some capex and maintenance capex spending on this to make sure that the expected revenue what we are getting from the market is achieved. So we expect 2 to 4 crores of maintenance capex on the existing plant and machine.
Okay. So that will be the overall 2 to 4 crore additional over the cost of acquisition that you will have to spend to kind of revamp the whole plant.
On plant maintenance.
Which will help us then reach the peak capacity utilization of 100-120 crores per annum, just maybe 2 to 5 crores of capex.
Okay. And this 120 crores of revenue can be achieved through the existing network, or for that also you will have to spend more money?
No, see, that's a function of, we don't have to spend money for distribution. That's just market development activities that any brand does. If we do that in piping, even at 3,000 crores and 7 to 8% market share, we continue to expand distribution to grow the business. So I think network expansion is going to be an activity which never completes, and you're never going to have a perfect distribution. So network expansion we continue to do not only for Bathware but also for our core business of pipes, fittings and water tanks. So that's an activity which will never end. And it will always be a lever for growth across segments.
Sure. And say at peak revenue of what you're targeting, 110 to 120 crores, the margins would be more or less similar to existing margins, or you believe it would be better?
So initially it would be lower because we will be investing more in brand and manpower, and the sales will not be enough to absorb that. Then in the long run, if you see typically in this kind of industry, I believe there is more value addition possible. If you understand the very basics, in pipes and water tanks, it's all standardized products where product differentiation actually is fairly limited. You are more selling in terms of, range and new products and distribution access. But in a product like Bathware, there is more product differentiation that is possible because of designs that you can be ahead of the curve with. There is also service is one way that you differentiate yourself. So because there are more differentiators in this business, I believe there is more value addition that can be done in the long term. And even if you look at the existing players in the Bathware space, typically have operating margins of 14 to 15%. So I think 5 years from now, this will be the most profitable vertical for us. But I think that's a long way ahead. Right now, we just need to focus on market share, distribution, and creating visibility at the point of purchase.
Sure. Got it. So, yeah, that was helpful. Thank you very much.
Thank you.
Thank you. The next question is from the line of Keshav Lahoti from HDFC Securities. Please go ahead.
Yeah. Just want to understand, Aquel right now targets which geography where its distributor is spread and revenue is coming from?
West, Central, and parts of South.
Okay. So your entire Bathware sales now will have the Aquel written on this, entire Bathware?
Yes. So pan-India, because they do have, it's a pan-India brand, but the presence is in the West, Central, and Southern markets. But now, post this acquisition, there will be one brand, which is Aquel. So product will say Aquel Pan-India, and packaging and collaterals would say Aquel by Prince Pan-India.
Okay, got it. And what are your plans for Bathware in FY25 on revenue side, on maybe EBITDA side?
Yeah, so I think, like I said earlier on the call, maybe in the next quarter earnings call, we would be able to share specifics. Right now, the focus is on integration of the range as well as distribution.
Okay, understood. Got it. One last question from my side. The pricing action which you wanted to bring on, piping side, some price correction. How are the things going on that front?
Pricing action has been taken. We believe now we are at a competitive price in PVC and CPVC relative to our top two peers. and where the action has been taken in December and January. And for that to reflect, it would take a few months in terms of volumes. But that action has been taken, and now we are just waiting for the results to show. And quarter 4 has been going well, and we believe that we will match the guidance that we have given, and we will start our growth engine from the June quarter.
Okay, that is good to hear. I'll just add one additional question. The 35 to 40 crore replacement cost, which you said, can you split it up like land is 10 crore, what are the other elements, equipment and everything?
For the replacement or for our acquisition?
For replacement, what 35 to 40 crore you said would be the replacement cost. So its bifurcation is what?
So see, it depends on where the plant is, and a lot of, there are many variables. The land cost has a very, very large range, depending on where you put up the plant. Of course, majorly it would be for the building, the civil infrastructure, followed by the equipment as well as the manufacturing equipment as well as the utilities. So that typically takes a major part, but cannot give a very clear breakup because it depends on where you put the plant and a lot of other variables.
Okay, got it. That's it from my side. Thank you.
Thank you. The next question is from the line of Achal from GM Financial. Please go ahead.
Yeah, just a quick clarification. 55 crore upfront plus whatever 2, 4, 5 crores incremental capex, 60 crore on top of that working capital. So, I mean, when you reach 100 crores of revenue, what kind of working capital would it require? Would it require like, 90 days, so additional whatever 25, 30 crores. So what is the ROC on this piece? I mean, just from this particular asset perspective or, acquisition perspective.
So I think working capital will be very similar, where, debtor days, if we have to grow, would be around, 40, 45 days, keeping an inventory of 1 to 2 months. So I think working capital does not look like it will be very different from what the current working capital cycle is.
Right. So in that case, 14-15% margin on 70-80 crore is like 20% pre-tax ROC. Is that the fair way of?
I think, Achal, it cannot be seen this way because first few years, EBITDA margins will not be 14-15%. There will be a higher investment in branding and manpower as well. I think 13 to 15% kind of operating margins are possible in the long term over 4 or 5 years. I think instead of seeing it this way, I would put it slightly differently. I think for the next 2 to 3 years, focus just has to be on penetration and ramping up market share, adding distributors, serving existing distributors, adding new distributors, investing in branding at the point of purchase in terms of showrooms and visibility for the Aquel brand. And right now, focus has to be on market share. In the long run, then we can have the luxury of focusing on profitable and certain X% margin, X times ROC and all of that. But I think next 2 to 3 years, we just have to put our head down and build a strong brand and build a strong distribution. And I think the rest will take care of itself over the next, over the long run.
Thank you, sir. The participant has left the queue. Can we move on to the next question?
Yes, please.
We'll take the next question from the line of Arun Baid from ICICI Securities. Please go ahead.
Yeah, Neha, just one clarification. You mentioned this plant can do about 120 crore revenues with this 1 lakh pieces capacity. Is that correct?
So when we say in numbers, we say in sets. It means it's a set. So 1 lakh is the capacity we quote in sets, and one set consists of numerous number of items, typically 8 to 10 items, and each item comprises of 6 to 8 parts. This is how we have to see in terms of the whole set. So what Nihar mentioned, 1 lakh capacity is on the sets.
Okay. And you mentioned earlier that this, product quality is more or less equal to Jaguar or maybe better. So how's the pricing here going to be? Is it going to be at par? How's it going to pan out there?
So we have, there is a range across multiple price points. Because today, gone are the days where you only sell premium or only sell mass premium. You have to have price points, you have to have products across price points, because even in one house, there is a certain range used in a master bed, certain in a normal, and then certain for the maybe your health. So there will be products at every price point. Given the kind of quality that we are giving and the kind of brand that Aquel has, yes, it will be from a brand point of view, a brand recall point of view, it will be top of the pyramid. But right now focus is on gaining market share.
Just to clarify, in each of the segments where we are going to be, because there are multiple price point segments that you mentioned, we'll be in line with the leader, right? Is that correct understanding? Pricing.
So we would benchmark the leader. We would have to sell at a discount because they are essentially, they are a very, very large incumbent growing aggressively. So it would be wrong, it would be delusional for me to think that we can price exactly at that price point and still grow. There has been some dilution because of the lack of supply. So we will now this gives us the luxury to not look at the other brands and other new entrants and maybe some of the existing smaller brands. Now we can at least benchmark with the incumbent and sell at a discount relative to the incumbent. But now at least the benchmarking is done versus the incumbent, and this we are saying basis our interactions, multiple interactions. A lot of homework has been done in terms of interacting with distributors and retailers across India. So now we will be able to basically benchmark the incumbent and really scale this brand to a new level.
And just one thing more there, you mentioned that we'll go back to the growth engine from June quarter, industry leading growth. Just one clarification here, because the most of the bigger players in industry are talking of at least a 15% of growth next year. It is indicating that. So are we trying to say that next year we're going to benchmark ourselves much higher than that?
So I'll stay away from this number game. I think at Prince historically we have been conservative with guidances, and the numbers have spoken for themselves, and we are confident. Fundamentals remain the same, and we continue to aggressively put up capacity. So instead of speculating on whether growth will be 10% or 15% or 20%, I think the numbers will talk. We have delivered in the past, and we are confident that we will deliver in the future, simply because fundamentals have not changed. This year has just been tough because of the ERP transition and then the resultant supply chain issue and some of the pricing action which we have already corrected. So whatever is controllable in terms of putting behind the ERP challenges and taking the corrective price action, that has been done. So the action has been taken. Now for the result to come into place, we have taken a quarter's time and guided for growth from June's quarter. So I've never been a fan of the number game, and I will continue to stay away from that, and the numbers will talk for themselves. I think we have to focus on execution in terms of product distribution and adding capacity, and we will whatever has helped us grow till now and whatever has helped us lead the industry in terms of growth, there's no rocket science and no secret sauce. The same levers will continue to help us grow at industry leading space. So I will stay away from playing this number game, and the actions will talk for themselves.
Thanks, Neha. Thanks.
Thank you. We'll take the next question from the line of Utkarsh Nopani from BOB Caps. Please go ahead.
Hi, good afternoon, sir. Sir, I just need few clarification. First, for the Bathware, whether this Bhuj facility can entirely take care of our faucet requirement for the next 2 to 3 year period, and for sanitary ware, whether we would be still remain dependent on that outsourcing model.
Sanitary ware we will continue to outsource. So even large players outsource that to Morbi. There's enough capacity and enough quality product available at competitive pricing. So faucets we will manufacture at Bhuj. Certain parts we would continue to outsource, which doesn't make sense to manufacture in-house, which also is an industry practice. But sanitary ware we will continue to fully outsource.
And so we don't have any plan to put up the sanitary ware plant in near future?
No plan in the near future.
Okay. And so for branding, you mentioned that for faucets, we plan to sell under Aquel brand. And for sanitary ware, also we plan to sell under the same Aquel brand name or under Prince brand name?
Aquel. Now all bathware, be it faucets, sanitary ware, showers, accessories, all will have Aquel. So you will have a synonymous branding and one family for bathware.
Okay. And so lastly for faucet, whether we need to put up the facility in other part of the country or whether this facility can take care for the pan-India requirement for us?
This facility will take care of pan-India requirement for us because currently there's only 2.5 acres which is utilized out of 8 acres. So basically, we can increase this capacity 3 times, possibly even more. And this is not a product like pipes where freight is 5 to 7% of your overall cost structure. The value per truck of faucets is significantly higher than pipes. So even if you look at the existing players, you either have a plant in Gujarat or in North India and you are able to serve the entire country because it's not a logistic sensitive business. So now we will just focus on first sweating out the Bhuj asset and then incrementally adding capacity. So I don't foresee for next 3 to 4 years we will have to look outside of this facility. Minimum 3 to 4 years.
Okay, got it, sir. Thank you.
Thank you, sir.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to the management for their closing comments. Over to you, sir.
Yeah, thank you, Arun. Thank you all for attending the call. Thank you.
Thank you, members of the management. Ladies and gentlemen, on behalf of ICICI Securities, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.